In our first video on Chapter 4, we looked at the purchasing side of a merchandising company. In this one, we will be looking at the sales side of a merchandising company. For one thing, many of the terms that we used for the purchaser are similar to what we use as far as the seller is concerned. The difference is, again, we'll be using perpetual inventory, which means that for most instances we will make 2 entries instead of just 1. The credit terms are the same type of thing that we had before, 210 net 30, a 2% discount if paid within 10 days of the invoice date. If not, the net or total amount is due within 30 days pardon me, of the invoice date. And so if we sold merchandise without these credit terms, there was no credit or cash discount, and we sold merchandise on account for $300 that had cost us $1,800. For the revenue side, the journal entry is going to be a debit to accounts receivable and a credit to sales for $3,000. So our sales account has taken the place of like service revenue. On the cost side, we have to recognize the cost and reduce our merchandise inventory. So the journal entry that we would prepare here would be a debit to a new account. It doesn't have the word expense on it, but it is our major expense account, and it is called cost of goods sold. So we're going to debit cost of goods sold for the $1,800, and we're going to credit our merchandise inventory account for the $1,800. So we've increased our revenues, increased our receivables, but we've increased the cost of goods sold, and we've decreased our merchandise inventory. If we made the exact same sale and we had credit terms and the buyer pays within the discount period, the revenue account then will look exactly a little bit different. They're paying within the discount period. And so what happens is we're going to pick up a new account. We're still going to take that $3,000. We're still going to multiply it by our 2%, and we're going to come up with $60. So this customer is not going to have to pay us the $3,000. All they're going to have to pay us is $2,940. So when we make our entry here for our sale, it would be exactly the same as we have here, and we're still going to debit accounts receivable for $3,000, credit our sales for $3,000. Our cost will still be cost of goods sold, get used to that abbreviation, and a credit to merchandise inventory for $1,800. But when they pay this invoice, then what we're going to do is we're going to debit cash, and we said that that cash would be $3,000 minus $60, which to me looks like $29.40. So we're going to debit cash not for $3,000, but for $29.40. And we're going to credit accounts receivable for $3,000. And what happens in there is we're out of balance by our $60. And so what we're going to do is we're going to pick up a new account, and that new account is called Sales Discounts. And that's going to be for our $60. And so what we call sales discount we call this sales discount a contra revenue account. And so it has a normal debit balance. And so technically what it does is it reduces the amount of our sales by this discount that we have given. If the buyer pays after the discount period, then it's just going to be our regular old cash debited for $3,000, and accounts receivables will then be credited for $3,000. Okay? So just like with purchasers, we can have a discount, but when it's a purchases, we adjust our merchandise inventory account. We don't do anything with a contra account like we have as far as sales discounts are concerned. Okay. We also have, just like we have purchases, returns, and allowances, we have sales returns and allowances. So if we sold somebody something, so basically we had a sale for $5,000 and it had a cost then of $4,000. We would make our regular entries just like we did up here. We would have debited accounts receivable and credited sales for $5,000. We would debit cost of goods sold and credit merchandise inventory for $4,000. Okay? So what happens is that our customer then returns some of this merchandise. Let's say out of the $4,000, they returned, let's say that they returned $300, and that $300, okay, had a cost of $200. Okay. So when we get this merchandise back, what we're going to do depends on whether it was a cash sale or a credit sale. But let's say they returned it for cash, then we will debit an account called sales returns and allowances. Okay, and that sales returns and allowances would be for our $300, and we would credit cash if we gave them the money back, or reduce accounts receivable if we'd sold it for $300. So this entry is the entry that we would have to make. Okay, the offset, remember, 2 entries. If we return the merchandise to our inventory, maybe the customer just didn't like the color of it, okay, but there's nothing wrong with it and we can sell it to someone else, then what we will do is we will debit merchandise inventory for our $200 and we'll credit cost of goods sold for $200. And so the merchandise inventory goes up, cost of goods sold goes down, and we can sell this material to someone else. If, on the other hand, the returned goods are defective and we cannot do this, then basically, pardon me, if the entire goods are defective, then basically we are not going to do anything. We just, cost of goods sold is there, the merchandise inventory is down, but if it's defective and we could get something for it, so if instead of it being worth $200, the cost that I can now not sell it for the original amount, if instead I figure that the true cost of this merchandise now that I'll my markup on is $180, not $200, then I will debit merchandise inventory for the $180, and I will debit a loss on defective merchandise for $20, and then I'll credit my cost of goods sold for the $200 that I had. Okay. And what this does is it puts it back in merchandise for what I thought. The cost of goods sold is reduced, and then we have a loss on the sale of the merchandise. It's like anything else. If we have an allowance, then basically we're going to debit our sales returns and allowances and credit cash or accounts receivable. And remember, with an allowance, the buyer is going to keep that merchandise, so we don't have to do anything about it except record then the return and reducing their accounts receivable. Okay, so that kind of leaves us towards the end of what happens. And one of the things that then transpires is this: adjusting entries. Okay, and I'm just going to write up here that you still have the adjusting journal entries from Chapter 3, but the special adjusting entry for a merchandiser is just basically usually one entry that we are making. And what happens is that if you went out and you looked at your inventory, so you looked at your merchandise inventory account, and it had a balance in it of $80,000. And then you took a physical inventory count and you found out that the inventory showed $78,000. Okay. Basically, what you have here is then inventory shrinkage. That's a nice word for calling it. It could have been that something became defective before you were able to sell it, so you had to throw it away, like expired lettuce or milk or something like that. Unfortunately, it also could be that someone has helped themselves to some of your merchandise. And so, if this case, then your inventory shrinkage is the $2,000. And so the adjusting journal entry that we have to make would be a debit to cost of goods sold and a credit to merchandise inventory for $2,000 because the inventory account has to balance to what the physical count was, not to the dollar figure that you had as far as your inventory account was. Okay. We have closing entries just like we had in accounting in our last chapter when we looked at closing entries. A merchandiser has closing entries as well. There's only some slight differences. We're still talking about temporary accounts. So again, we're still talking about our revenue account, which basically now is our sales account. We're talking about our regular expenses. So we're looking at new accounts now, new temporary accounts. And for expenses, it really is cost of goods sold. Okay. It could also have been inventory. Well, it could have been anything that we had before, like salary, expenses, and all the other ones. But now we have some new accounts that we have to look at as well. And those are those contra revenue accounts. They also have to be closed. And our contra revenue accounts were sales discounts and sales returns and allowances. So there really aren't any new contra accounts as far as the purchasing side because we're using a perpetual inventory system. We just keep adjusting the inventory account itself. And since our merchandise inventory account is an asset and we use it every time we increase or decrease the value and the size of our inventory, we don't have to do anything about closing that either. So basically, you close the revenue account and we simply debit sales, okay, and we credit our good old income summary account. Okay. And so we have put a zero balance in our sales account, and our income summary account now has a credit balance for the amount of our sales. We now close our temporary accounts. And so just like what we've done before, we're going to debit income summary and credit all of our new expense account, our new contra revenue accounts, and our old expense accounts. So what we're going to do is, and the order doesn't really matter, but we're going to credit our sales discounts, our sales returns and allowances. We're going to credit our cost of goods sold, and we're going to credit each of the other expense accounts. And now our income summary has this, and the value in our income summary, just like it was before, is the amount of our income. And so the last entry, the last couple of entries are the same as the ones that we've made before. The first one, hopefully we've made a net income. And so if we have made a net income, then the income summary account will have a credit balance, and we'll debit income summary and credit retained earnings. Unfortunately, if we'd have had a net loss, our income summary account would have had a debit balance, and we would have had to have debited retained earnings and credited income summary. And the last one is the regular one to close our dividends account with a debit to retained earnings and a credit to our dividends account. So with our videos 1 and 2, we've just about covered all of the transactions and the journal entries that go with a merchandiser. And if you want to look at basically page 184, that is the place in the book through 185 where we are basically showing you a summary of the merchandise entries. The next video that we will do for our Chapter 4 is we're going to take a look at the multiple step income statement.